Tomas, we are back, my friend. You know what that means. Time for a little bit more Tasty Live with this man, Chris Vecchio, and let me explain. What's up, Chris?
Gentlemen, how are you this Tuesday?
I'm doing great. How about yourself?
I'm not doing too shabby here. We're on the other side of the NFL playoff weekend, which means it's time to start thinking about these markets again, because quite frankly, who cares about the Chiefs? Who cares about the Ravens? Not me. I'm looking forward to next season, as I'm sure you guys are. But more importantly for these markets, I mean, this is an interesting week on the calendar. Earnings are starting to pick up. We have Netflix after hours today, of course. We're going to have Tesla later this week. It's a busy week on the macro calendar, but not necessarily for the U.S. There was a Bank of Japan rate decision last night. We're going to hear from the Bank of Canada, the European Central Bank in the coming days. But I suppose all attention is on what's happening with our economy itself, what's going on with our growth rate, because bond yields have been ticking higher here over the course of 2024. And by and large, it's come alongside a reduction in inflation expectations in the market, which is to say that this is kind of the Goldilocks scenario that's playing out right now. People are pricing in higher growth. They're pricing in a Federal Reserve that doesn't need to cut rates as much. And so when we look to GDP this week, the Atlanta Fed right now is pricing it at 2.4%. There's probably a skew to the upside given the trajectory of the data recently and what's likely to come down the pipeline. So as far as we're concerned, at least from my macro point of view, this rise in yields may not be over yet at this point in time. What's been really fascinating, and Tom, I do want to give you credit because you called this out at the end of last year when I said my preferred, or one of my preferred trades for this year was looking to fade any upticks in bond volatility. You said, you don't think I'm going to get that opportunity. And thus far during this decline in bond prices, where's the vol? It keeps getting sucked out of this market. You're not looking at IVRs in the 30s or 40s anymore in ZN or ZP. You're barely looking at things that are double digits now across the board. So right now, a more difficult environment, I think, for options traders in the bond space, but it's not one that we should look to get too hasty about because there could be some more pressure in yields ahead. So gentlemen, explain to me, how are you treating bonds this year now that the volatility has disappeared?
That's, so Chris, we're a very predictable kind of, we're like a one-trick pony. And what that means is that when vol drops, like bonds don't even exist to us.
Yeah, because
we're like we love bonds. We love trading them. We love trading the vol. We love trading the direction, everything else. But once the vol drops out, they're not interesting to us. Like we don't. It's a little bit of the difference between the way you think about markets and the way we think. It's not. I'm not saying one's better than the other, or worse, or whatever. We just, opportunity to us is vol based rather than some bigger picture, rather than some story. So for us, when vol is high, there's a short premium play, and there's also an expected move play, right? Both of those are, both those derivatives of or opportunities presented by high vol. When the vol comes out of something like the bonds, or the vol comes out of something like the notes, what's left for us? Well, there's the yield curve trade, which has come down too much at this point. It's not interesting to me either. It's too, it's too flat right now. And then there is, maybe you can have a little directional bias or something like that. I thought when they got up to 125, 126, they were too rich. We were right about that. Down here at 120-ish, 119, I mean, we've been playing them pretty close to the vest, pretty flat. Right now, our only position in the bonds is a very small, I'm just looking right now, kind of a very small at the money strangle, which I probably shouldn't even have on. Meaning because there's just not enough vol in there, but it's just kind of a residual position. So what it does is it lets us just kind of follow track. Like sometimes we keep positions on for tracking purposes. I know that sounds weird, but if we have a position
you're
on,
looking to make money in them too.
we of course we want to make money, but we'll watch them, but we'll reduce our size by 60, 70, or 80%.
Right.
So the bonds right now are uninteresting to me. I know there's a lot of talk and everything else, about things that are going on and yada, yada, yada. But for us, a very uninteresting product simply because they've lost their vol. So the range is predictable, the vol is predictable. It's just, bonds were in favor for 18 months as a great trading vehicle. I think they're kind of out of favor.
Mm-hmm.
That's it.
They may have fallen out of favor, and I think that's kind of the conclusion that I'm getting at here, which is to say that if you've been looking for an uptick in vol during a sell-off, it's not here right now. So there's not really a great opportunity per se in the very short term. Look, I guess if there's you have to be in the market, as Anton likes to point out about these things on Futures Power Hour. If you're bullish on something and vol is already low, it may be more prudent to look at something like an at-the-money call spread rather than selling an out-of-the-money put spread. But that's more of a directional call then. It's not really one predicated on an ideal volatility environment. So bonds have been a bit of a disappointment here through the first 3 weeks of this calendar year. You got to stay patient in this market, and maybe there's going to be more opportunity around the corner because the GDP data this week, the PCE data, ultimately could provide some sparks. Those are on Thursday and Friday, respectively. Other than that, we're all eyes on the Federal Reserve because the Federal Reserve is meeting next week. They're in their communications blackout window right now, thank God. You don't need to worry about those comments moving the markets on a minute-to-minute basis. But what we do see is that over the past week and a half, there's been a dramatic shift in Fed cut odds for the month of March. March makes sense as a starting point for when the market may see those cuts coming. It's 8 months after the July hike, and typically it's 8 months between the end of the cutting cycle and the beginning of a hiking one in Fed history. But right now, we've seen that the March cut odds have dropped from 81% where they opened last week to where they sit today, currently at 42%. That's a pretty steep drop off in a short period of time. And of course, it's perhaps one of the driving factors what's been going on with U.S. Treasury yields. That said, however, when we think about how the data is evolving, January, it's too soon after the December meeting to matter. I think the next week and a half, if you're paying attention to anything's in this market, you got to be paying attention to earnings. Earnings may matter more than the Fed or macro data. Period. End of story. None of these central banks appear poised to do much of anything in the days ahead. And Tom, like you said, if there's no volatility there, why are you looking at it? Why are you trading it? Unfortunately, that renders much of the FX space useless still. The yen has a bit of volatility in it compared to some of its peers. The IVRs have been sitting right around 20, although they've been dipping back after this BOJ rate decision. So you got to stick with what works. And what's working right now is not necessarily trading anything that's dead as a doornail in the water. I have positions on right now looking to I have orders sitting in here for an iron condor in gold. I have a position looking to be executed right now, a short put spread in crude oil, because look, if they're continuing to work, this is one of those weeks where if it's not broken, don't fix it. And like you guys said, you got to go to where the vol is right now. And so that's where the vol is, in metals, in oil. And that's a one-trick pony, Tom, I will continue to stick to because it's the gift that keeps on giving here, at least since early December.
Yeah, we do have a metals position on, but it's a little Pete Mulmat inspired trade from the weekend. We sold gold and bought silver. It's working today. I think we're about unchanged on the position. It was down yesterday. It's up today. We're doing it 1-to-1. I think the gold silver ratio is over 90, and I didn't check it, yesterday. I know it was a little against us. It was 89.6 the other day, so I think it's just over 90. It's the highest level it's been at. That's essentially a 1-to-1 trade. Buying silver, selling gold, which means that on a relative basis, silver's cheap compared to gold, so we put that trade on.
It's at its lowest level, just off of its lowest level.
Yeah, is it over 90? I think it is over 90.
90.2 right now. Yeah.
What is it?
90.2.
90.2. Okay, yeah, so it's just over 90. And when we look at the IV rank in gold and silver is actually it's too low for us to sell premium in there. So we're just going pairs route. But again, that's kind of what I was saying before. We're IV players, but when there's no IV there, we will look for other things that we think are at some kind of price extreme. And that gold silver ratio, that's pretty cool because that's at a price extreme. That's a very risky trade. It really moves around. So you got to do it super small. But there's micro contracts on both. And, so at least we got that going for us. So I think the possibly the more interesting thing today, Chris, is it's going to be how these, we really haven't had any earnings yet. I mean, I know we had UAL this morning.
Netflix this morning is going to be the start of that.
No, I know we had UAL last night. It's up.
Yep.
Well, it's still up strong. It's up 350, and after the horrible earnings they had in Delta Airlines, this is a nice turnaround. It's for sure going to help our love. Well, maybe it won't help our love position. Love actually just went up a little higher than I thought. But what do you think about earnings here? What do you think about, like, is this market, when the market's at record highs and vol's cheap, earnings are a really tough trade. So earnings, Netflix, not Netflix, UAL worked finally, something worked, but like Netflix everything scares me earnings wise. When we're starting at these low levels of vol, anything
the entry scares you is what you're really
close to the expected range. Like, what did 3M do last night? What did those other stocks do that
Let's
earnings?
take a look. 3M down $10. That's a big
outside the
move.
expected
That's a
range.
big 10.
Yeah, what was the other
10%
stock?
expected move. Johnson and Johnson was another one.
Yeah, I mean, these stocks are
Down almost $5.
yeah, that's outside the expected range.
VZ.
Here's the thing: they're all like
Up to.
so the majority so far have been outside the expected range, and even if you're close to the expected range, it's hard to make money. So Netflix is what, $38?
Approximately, maybe a little bit less.
I went 100 wide in there. I don't even like my position.
No.
I'm just saying. So what do you think about earnings? Can earnings move this market? That's really I think the bottom line.
Well, I mean, you raise a really good point there, which is to say that basically everything is priced for perfection right now. So there's kind of asymmetric risk when you're trading around these earnings. It's different when you're going through a muddling economy or stock market because there's a wide range of opportunities on both ends. But right now, this market is clearly, as you know, up at all-time highs, which means people feel pretty good, or as good as they've ever felt about things. That said, the earnings that have come out of your Johnson & Johnson, your Procter & Gamble, your UAL, these aren't bellwethers of the broader market. I think it's interesting that TSM, which is kind of a canary in the coal mine for the broader tech sector, at least when it comes to this AI narrative, that produces a bigger move than, quite frankly, anything else that we've seen thus far this earnings season. So if we're watching this broader market, I guess the attention is still on the Mag 7. There's all this talk. I'm one of those people talking about it, how it'd be nice to see some capital rotation at the start of this year. If this is truly a bull market, you see that breadth widening out. You see some of the laggards from last year pick up the slack, and, for what it's worth, the Russell has outpaced the NASDAQ, the S&P today. It's outpaced them yesterday. That's the kind of capital rotation you'd like to see in a strong bull market.
That doesn't surprise you, though. It doesn't surprise us.
No, it doesn't. No, not a surprise whatsoever, right? But it's this is a market that is priced for perfection. So you're going to have to look to your NVIDIA. You're going to have to look to your Microsoft. Netflix, of course, will matter. But some of these smaller things, these idiosyncratic risks, like a J&J, right? How is that impacting people's sentiment at the top line? I don't think it is. And earnings growth is expected to be a little bit more positive, right? We just got out of negative territory after spending all this time down there for much of 2023. Third quarter rather, produced the first positive quarterly earnings growth rate in over a year. And now we're looking to back that up in the second quarter here. And more importantly, the economy is continuing to grow. It's much more resilient than people anticipated. Consumers are still spending an ungodly amount of money.
Does any of that surprise you? Like all the talk when people are like, oh, we're going, inflation is brutal, and I'm like, I don't know if it is, and the economy is going into recession. We're going, we're spiraling out of control. I never bought any of that because I just didn't see it, and I still don't see it. This is one of the strongest
Prices have gone. Consumer prices.
Consumer prices have, but the question is,
Sure.
Is it demand because just the economy's so hot? I mean, this is one of the strongest economies I've ever seen. And I know everybody likes to say, oh my God, this is, we're crumbling, but we're not. America's strong.
We're at all-time highs.
The market's at all-time highs. The
that.
corporations are flush with cash. This is the strongest I've ever seen this country as far as the economy goes. And so, I don't think that part's, what surprises me is the level of concentration. If there's one risk that I see, it's concentration risk more than anything else. And I know we've been saying that now for a couple of years, but I truly believe there's concentration risk. And that is actually pretty damn scary.
That could lead to some things tipping over, but you're right. I mean, the economy is strong. And as Stanley Druckenmiller said, like the best economist that he has ever met is the stock market. The stock market tends to lead the broader economy by 6 to 9 months. I know people think that the two are completely disconnected, Main Street and Wall Street, the two different things. And yes, that's true. But the stock market actually is shown to be a leading indicator for the broader economy. So the fact that you have equities up at all-time highs, even with interest rates where they are, it is a very strong sign. Look, I've been saying for the better part of a year now at this point in time, just check the scoreboard. We're at a 2.4% give or take growth rate annualized for 2023. The unemployment rate is 3.7%. Inflation is quickly trending down towards the Fed's target. For those inflation truthers out there, you can look to something like Trueflation, which does real-time measurements of private sector data, goods on the shelves in stores, and it's ticking below 2% right now. So no matter how you slice it, the Fed has done a pretty good job, certainly better than other central banks around the world, at getting the economy to where it is. And the federal government's still spending a lot of money here. That's a big part of this equation. When you're running the kind of deficits that we are, G has a positive coefficient in our GDP equation. It's going to add to bottom line growth, plain and simple. It's going to be difficult to get this economy into recession. And while my concerns about that were percolating towards the end of last year, some things have changed. Notably, the labor market has actually gotten a little bit more resilient. The continuing claims year-over-year change, it was up near 25% a few weeks ago, which is notable because every other time in U.S. history when you've had continuing claims up 25% or more year-over-year, you're typically at the start of or in the middle of a recession, plain and simple. We're now only up 10.5% year-over-year in continuing claims. So the labor market's good. It's not fantastic. There are some issues, but it's better than anyone thought it would be at this point in time. So that's causing a readjustment now in asset prices,
right?
and maybe
I mean, you don't want it
yields.
too strong, you don't want it too weak.
You know what's funny is I hope you're getting ready for tomorrow's debate.
Tom, I grew up with two attorneys. Like, I could roll out of bed at 3 o'clock in the morning and debate you guys.
I know.
You only have one attorney.
No.
He had two.
Hold on. Here's the interesting thing, because you just said something that I'm just gonna bring it up real quick. But you said Stanley Druckenmiller said, and the quote was,
The stock market is the best economist that he's ever known.
yes, the old efficient market theory rears its head, right?
Tom, save it for tomorrow.
I just want to bring up, like, you can't have your cake and eat it too. Okay, I agree with that.
Absolutely can. We are the French royalty. We can do whatever we want around here. Tom, look, the debate around fundamental analysis, like, there's a few definitions you have to work towards, but the market is the ultimate weighing machine. It is the collective representation of what we all believe are the value of assets at any given point in time. Some people's votes matter more than others.
Agree.
But that doesn't mean that fundamental analysis is illegitimate, because all of us have our different models.
I didn't say illegitimate. I just said
things.
that there's a lot of discussion. There's a lot of economists out there. There's a lot of discussions. But if the stock market is the ultimate, kind of measure of how we're doing, then
bond volatility is telling you that it doesn't matter what's happening soon.
That's a good thing.
Money flow,
which you said earlier.
Money flow is the true definition of value. That's what discussion we're going to have tomorrow. Mm-hmm. But money flow to me is the true definition of everything that we do. And it's the true explanation for everything that we do and the reason why we're in this business. The other stuff, it's just noise. And we're going to see how that plays out in tomorrow's discussion. Anton, by the way, flew into Chicago just so he could have this in person and be your teammate.
9 a.m. tomorrow. You ready?
I'm ready.
Jacob might not sleep tonight.
Jacob, by the way, hasn't answered any of our messages trying to get on the same page about this debate. So we don't know if you guys are trying to pull a fast one or you're already running scared. But we'll see. Jacob
is just playing. He's just,
playing possum.
He's playing possum. He doesn't like to show his hand. He doesn't like to, Jacob's very coy that way.
Slow playing you.
Yeah, he's worried about you guys. He's a little nervous. I tell you, he couldn't sleep.
He's worried you're going to cry.
Yeah, he's scared. He's a little scared. He'll come
That's
out.
Fair.
He'll come guns blazing, though. Don't worry.
We're ready.
I know. It's going to be fun. Anyway, let's see. Parting words here. Tony or Chris, any parting words? It's just after 9, so we're going to run if you've got nothing else. That was a good discussion.
I mean, there's really nothing else today. This calendar is quite quiet the rest of the session. There's a 2-year note auction that will be released at 1 p.m. Eastern. Maybe that moves the short end of the curve. We've seen how bond auctions can domino into the broader market for the rest of the day. But outside of that, today is a quiet Tuesday, and there's a reason why vol is priced the way it is. Don't force a trade, folks. Trade small, trade often.
We'll be back in 90 seconds. We got more Tasty Live after this with a market measure next. Thanks, Chris.